Wesley Snipes, the Hollywood star of Blade, earned millions at the peak of his career. Yet despite his fame and fortune, he ended up in court, even serving prison time, because he failed to pay his taxes. His downfall proves a brutal truth. The IRS doesn't care if you're a celebrity or a beginner investor. Ignore taxes, and they will take everything. That same danger applies to your stock market gains. In this video, we'll break down how investment taxes really work so you don't fall into the same trap. Because keeping your profits isn't just about smart investing. It's about smart tax planning. Meet Sarah and Victor. Sarah buys stocks, holds them for years, and sells at a profit. Victor trades daily, flipping stocks for quick gains. Both make money, but their tax bills look very different. Why? Because the government treats long-term gains and short-term gains differently. Sarah pays a lower tax rate because she held her stocks for more than a year. Victor, however, pays ordinary income tax rates, which can be much higher. Their stories highlight the first golden rule: time matters in investing. Holding longer isn't just safer, it's often cheaper when taxes come knocking. Here's the twist: not all money from the stock market is treated the same. Dividends, capital gains, and interest each fall under different tax categories. Dividends act like bonus checks from companies. Those are taxable. Capital gains, that's profit from selling your stock. Interest? Taxed like regular income. The IRS doesn't care if it's a few dollars or thousands. It wants its share. The key is knowing which bucket your earnings fall into. Once you understand this, you can plan smarter, avoid confusion, and stop treating every dollar as equal. A beginner buys Tesla stock, sells it 2 months later, and doubles their money. They're thrilled until tax season. That gain is taxed as ordinary income, just like their salary. Suddenly, instead of celebrating, they're paying a hefty bill. This is the short-term trap. Many beginners chase quick wins, not realizing the tax bite is bigger. The lesson? Sometimes patience isn't just about market risk. It's about lowering your tax burden. Long-term investing rewards discipline not only with growth but with lower taxes. Now consider holding Apple stock for 2 years. When you sell, your profit is taxed at a lower rate, sometimes as low as 0% depending on your income bracket. That's the beauty of long-term capital gains. Governments encourage patience by rewarding investors who hold. It's like a loyalty bonus for staying in the game. This is why seasoned investors preach buy and hold. It's not just about compounding wealth, it's about compounding tax advantages too. Dividends often feel like the sweetest reward in investing. You buy shares, and suddenly the company thanks you with cash in your account. It feels effortless, like money working for you. But here's the reality check. Dividends are not free. The taxman is waiting. Qualified dividends, usually from U.S. companies that meet certain rules, are taxed at lower rates, giving investors a break. Non-qualified dividends, however, are taxed just like ordinary income, meaning they can push your tax bill higher. Consider 2 investors. One builds a portfolio of dividend-paying stocks, enjoying steady payouts. The other focuses on growth stocks, reinvesting profits for long-term appreciation. When tax season arrives, the dividend investor faces a heavier burden, while the growth investor may owe less. The lesson is clear. Dividends are powerful for passive income, but without tax planning, that bonus check shrinks quickly. Smart investors celebrate dividends, but prepare for the bill. In the world of investing, some beginners believe small trades fly under the radar. They think it's just a few dollars, no one will notice. But the IRS notices everything. Every trade, every dividend, every gain is reported by your broker directly to the government. Months later, the unsuspecting investor receives a letter: taxes owed, plus penalties and interest. Suddenly, the profits they celebrated are gone, swallowed by fines. This is the harsh reality. The IRS is the silent partner in every trade. You can't hide and you can't ignore. Transparency isn't optional, it's survival. Seasoned investors know that reporting gains and losses accurately is as important as choosing the right stock. The market rewards risk takers, but the tax system punishes neglect. The moral is simple: respect the rules, keep your records, and never underestimate the IRS. Because in investing, profits vanish faster than you think when taxes are ignored. Losses sting. Watching $1,000 vanish from your portfolio feels like failure, but here's the hidden advantage. The tax code allows you to turn that pain into power. This strategy, known as tax loss harvesting, lets you use losses to offset gains, reducing your taxable income. Think of it as the market handing you a coupon for your missteps. Beginners often panic, selling in frustration and walking away. But seasoned investors know losses are tools. They don't just accept them, they deploy them strategically. A $1,000 loss can cancel out a $1,000 gain, meaning you owe less tax. And if your losses exceed your gains, you can even deduct part against regular income. The market punishes recklessness, but the tax system offers redemption to those who understand the rules. Losses aren't the end of the story. They're a chance to rewrite it in your favor. Taxes are like a courtroom, and every investor is on trial. Your defense isn't a lawyer, it's your records. Every trade, dividend, and loss must be documented with precision. Brokers provide 1,099 forms, but mistakes happen, and relying solely on them can cost you. Smart investors keep their own detailed logs, dates, amounts, reasons for trades, and even notes on market conditions. Why? Because when tax season arrives, clarity saves money. Forgetting to record a loss means you pay more tax than necessary. Missing dividend details can inflate your bill. Records aren't boring paperwork. They're shields against overpayment and penalties. Treat them like treasure maps guiding you through the chaos of tax season. Organized records transform stress into confidence. The IRS demands proof, and with meticulous documentation, you're ready. In investing, numbers tell the story, but records ensure the ending is in your favor. Two investors walk away from the same market year with very different outcomes. One ignored taxes, assuming profits alone meant success. When the IRS came knocking, half his gains evaporated. The other planned carefully, tracking every trade, harvesting losses, and holding long-term positions. His profits stayed intact. The difference wasn't luck. It was knowledge. Taxes are the hidden battlefield of investing, where discipline wins and ignorance destroys. Picking the right stock is only half the game. Keeping what you earn is the other half. The market rewards boldness, but the tax code rewards preparation. As you step into the world of investing, remember this mantra: profits excite, but taxes decide. Mastering taxes means protecting your wealth, securing your freedom, and ensuring your financial journey doesn't end in regret. Knowledge isn't just power, it's profit preserved.